Preparing for FP&A Analyst at PSEG interview? You've reached Candy Mentor, and this video is for you. We'll walk through 25 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. What does FP&A mean to you, and how does it support a company like PSEG? FP&A turns operational information into decisions about resources, risks, and performance. At PSEG, I would connect finance with generation, transmission, distribution, customer demand, capital projects, and corporate functions. My responsibilities would include maintaining forecasts, explaining variances, challenging assumptions, and presenting concise insights to leaders. I would not simply report that expenses were unfavorable. I would identify the operational cause, estimate the full-year impact, and recommend an action or forecast adjustment. While answering, focus on budgeting, forecasting, variance analysis, decision support, cross-functional partnership, and how FP&A connects operational performance with PSEG's utility reliability, customer, regulatory, and financial objectives. Question 2. Why do you want to work in FP&A at PSEG? I want PSEG because it combines rigorous financial analysis with an essential public service mission. Energy businesses require disciplined forecasting, significant capital allocation, and close attention to reliability, regulation, and customer affordability. That combination is attractive to me. I would bring strong Excel, accounting, communication, and problem-solving skills, while learning the operational drivers behind utility performance. FP&A also offers the opportunity to influence decisions rather than merely record historical results. Make sure to cover your interest in analytical finance, PSEG's energy and infrastructure mission, regulated utility complexity, stakeholder impact, professional development, and how your skills match the role's business partnering requirements. Question 3. Walk me through how you would build an annual budget for a PSEG business unit. I would begin with prior year actuals and the latest forecast, then separate controllable costs from volume, timing, and externally driven items. For a PSEG unit, I would gather assumptions on labor, maintenance, fuel, customer demand, capital projects, inflation, and regulatory requirements. I would review those assumptions with operating leaders, challenge unusual changes, consolidate submissions, and reconcile the budget to corporate targets. Finally, I would document assumptions and establish monthly tracking against the approved plan. In your answer, talk about historical baselines, operating drivers, stakeholder inputs, labor and O&M assumptions, capital plans, regulatory considerations, challenge sessions, consolidation, review, and budget governance. Question 4. How would you forecast revenue for an electric utility? I would forecast revenue using operational drivers rather than applying a simple growth rate. The model would consider customer counts, usage per customer, weather, seasonal patterns, approved rates, rate case timing, and major commercial or industrial loads. I would separately assess transmission, distribution, and other revenue streams where relevant. I would compare the forecast with billing and operating data, then run weather and demand sensitivities so management understands both the base case and downside risk. Be sure to mention customer count, usage, weather, rates, service territories, seasonality, regulatory mechanisms, non-core revenue, scenario analysis, and reconciliation to actual billing or operational data. Question 5. What are the most important operating drivers for PSEG's financial performance? The key drivers depend on the PSEG segment, but I would monitor demand, weather, customer growth, generation availability, fuel and purchased power costs, outage activity, labor, maintenance, capital investment, and regulatory recovery. Interest rates also matter because utilities are capital intensive. I would distinguish drivers affecting revenue, O&M, capital, and cash flow. The goal is to understand not only what moved results, but which indicators provide an early warning for future performance. Focus on electricity demand, weather, fuel and purchased power, outage activity, customer growth, labor, maintenance, capital spending, regulatory recovery, interest rates, and asset availability. Question 6. Explain how you would perform a monthly budget versus actual analysis. I would validate actuals first, confirm the reporting period, and compare results with budget, prior year, and the latest forecast. I would prioritize material variances and decompose them into volume, price, timing, rate, and one-time effects. After speaking with business owners, I would distinguish temporary timing from a structural change. My commentary would quantify the annual impact, state whether the forecast needs revision, and identify an accountable owner for corrective action. Mention data validation, actual to budget comparison, materiality thresholds, price-volume mix analysis, timing issues, root causes, forecast updates, management commentary, and clearly assigned follow-up actions. Question 7. How would you analyze an unfavorable O&M variance at PSEG? I would start by drilling from the business unit total into accounts, cost centers, vendors, and transaction detail. I would determine whether the variance reflects storm response, emergency maintenance, contractor rates, overtime, an accrual reversal, or routine work occurring earlier than planned. I would then quantify what is one-time versus recurring and discuss the operational cause with the manager. The conclusion should explain the full-year impact and whether spending controls or forecast changes are appropriate. In your answer, cover cost center detail, labor and contractor spending, maintenance timing, storm or outage activity, accruals, one-time items, controllability, annualized impact, and management action. Question 8. What is the difference between a budget, forecast, and long-range plan? A budget is the approved financial plan used to set annual targets and accountability. A forecast is management's current best estimate of expected results, updated as conditions change. A long-range plan looks several years ahead and links strategy with capital requirements, financing, regulatory expectations, and broader operating assumptions. At PSEG, all three would be connected, but I would avoid treating the budget as immutable when actual business conditions clearly require a forecast update. Make sure to distinguish fixed annual commitments, regularly refreshed expectations, and strategic multi-year outlooks. Explain their different purposes, detail levels, assumptions, and links to capital and financing decisions. Question 9. How would you evaluate a proposed capital project at PSEG? I would assess the project's safety, reliability, compliance, customer, and strategic rationale before focusing on returns. Financial analysis would include capital timing, operating savings or revenue, tax effects, useful life, financing assumptions, NPV, and sensitivity to delays or cost overruns. For a regulated utility, I would also consider expected regulatory recovery and rate-based treatment. I would compare alternatives, include contingency, and establish milestones for measuring whether the approved benefits and spending profile are being achieved. Discuss strategic need, safety and reliability, regulatory treatment, scope, timing, NPV, cash flow, risk, alternatives, contingency, rate-based implications, and post-investment performance measurement. Question 10. What is the difference between capital expenditures and operating expenses, and why does it matter? Capital expenditures create or improve a long-lived asset, while operating expenses support current period operations and maintenance. The distinction affects when costs hit earnings, depreciation, cash flow presentation, asset balances, and potentially regulatory recovery. I would follow accounting policy rather than classify costs to meet a target. For example, replacing a major system component may be capitalized if it extends useful life, while routine repairs generally remain O&M. I would involve controllership when the facts are judgmental. Cover capitalization criteria, useful life, depreciation, income statement and cash flow effects, project controls, maintenance distinctions, policy compliance, and how classification affects forecasting and regulatory reporting. Question 11. How do rate cases and regulatory decisions affect FP&A at PSEG? Rate cases can change revenue, recovery timing, customer charges, and the economics of planned investment. I would model the requested case, likely outcome, effective date, and potential delays, while distinguishing cash collection from accounting recognition. I would coordinate with regulatory, accounting, treasury, and operating teams because regulatory assets, liabilities, and rate-based treatment can affect different statements and periods. Scenario analysis would help management understand earnings, customer, and liquidity implications before a decision is finalized. Mention approved rates, timing, allowed recovery, regulatory assets and liabilities, cost of service assumptions, customer impact, earnings timing, scenario modeling, and coordination with regulatory and accounting teams. Question 12. How would you incorporate weather into a PSEG forecast? I would quantify the relationship between weather indicators and demand using historical periods, while controlling for customer growth, rate changes, and unusual events. Heating and cooling degree days could provide useful explanatory variables, but I would avoid assuming every historical relationship remains stable. I would prepare a normal weather base case plus warmer and colder scenarios, then explain the revenue and cost sensitivity. That approach separates temporary weather noise from underlying demand and customer trends. Focus on historical normalization, heating and cooling degree days, demand sensitivity, geography, seasonality, statistical relationships, scenario ranges, and separating weather effects from underlying customer or operational trends. Question 13. Tell me about a time you found an error in a financial report or model. In a prior analysis, I noticed that a monthly expense trend did not reconcile to the supporting schedule. I traced the issue to a duplicated data extract caused by an inconsistent reporting period filter. I confirmed the impact independently, notified my manager, corrected the report, and documented the issue before distribution. I then added a control comparing record counts and totals against the source system. That experience reinforced that review should test both formulas and underlying data. Be sure to use a clear situation, explain your validation procedure, quantify the impact, communicate professionally, correct the root cause, and describe a preventive control or documentation improvement. Question 14. How do you ensure accuracy when working with large financial datasets? I use a repeatable process, confirm the source and period, preserve raw data, transform information in controlled steps, and reconcile totals to the general ledger or approved source. I use consistent naming, version control, formula checks, exception flags, and reasonableness tests against prior periods. For important deliverables, I perform an independent review or ask a colleague to challenge the output. I also document assumptions and restrict access appropriately because financial data may be sensitive. Discuss source reconciliation, structured files, version control, formula checks, reasonableness tests, exception reports, documentation, peer review, and protecting sensitive financial information. Question 15. Which Excel or analytical tools would you use in an FP&A role? I am comfortable with SUMIFS, XLOOKUP, index match, pivot tables, conditional logic, charts, and scenario tables. I use Power Query when repeatable data preparation is needed and can work with SQL or business intelligence tools when available. My priority is not complexity, it is a model that is transparent, efficient, and easy to review. I separate inputs, calculations, and outputs, build checks into the workbook, and explain assumptions so another analyst can maintain it. Mention SUMIFS, XLOOKUP or index match, pivot tables, scenario modeling, Power Query, charts, error checks, SQL or by exposure, and selecting tools that improve control and repeatability. Question 16. How would you explain a complex financial result to a non-finance operations leader? I would lead with the conclusion in operational language. What changed, why it changed, and what it means for the full year. For example, instead of saying O&M was unfavorable because of accruals, I would explain that emergency contractor work followed an outage and increased current spending by a quantified amount. I would distinguish temporary from recurring effects, show a simple bridge if useful, and finish with the recommended action and any decision required. Emphasize business language, concise headline, operational drivers, quantified impact, visual support, implications, recommended action, and confirming understanding without overwhelming the audience with accounting terminology. Question 17. Describe a time you had to challenge an assumption from a business partner. A business partner once assumed a cost increase was entirely recurring because vendor rates had risen. I reviewed the detail and found that part of the variance also reflected accelerated work that would not repeat. I shared the analysis constructively, asked what operational events I might be missing, and built separate recurring and timing scenarios. We agreed on a more accurate forecast and documented the assumptions. I learned that effective challenge combines evidence with genuine curiosity. Use a respectful fact-based example, show how you tested the assumption, incorporated operational context, quantified alternatives, preserved the relationship, and reached a documented, decision-useful conclusion. Question 18. How would you prioritize competing deadlines during the monthly close and forecast cycle? I would map deadlines, dependencies, and materiality at the beginning of the cycle. Close deliverables and items affecting executive reporting would take priority, followed by forecast updates and lower risk analysis. I would use a checklist, reuse controlled templates, and communicate early if source data or review time creates a risk. I would not sacrifice key controls for speed. Instead, I would escalate conflicts, agree on trade-offs, and provide a clearly labeled preliminary view when necessary. Cover materiality, deadline dependencies, stakeholder expectations, early communication, standardized checklists, escalation, quality controls, and balancing urgent reporting with thoughtful analysis. Question 19. What would you do if actual results were unavailable but a forecast was due? I would first determine which data is missing and whether a reliable proxy exists, such as operational activity, vendor information, or the prior approved estimate. I would consult the responsible owner, quantify the uncertainty, and produce a preliminary forecast using transparent assumptions. I would clearly label estimated figures rather than imply they are actuals. Once the data arrives, I would reconcile differences, update the forecast, and explain whether the original risk was timing or a genuine performance change. Mention using the latest reliable information, estimating carefully, identifying limitations, consulting owners, documenting assumptions, labeling preliminary results, and updating promptly when actual data becomes available. Question 20. How would you build a scenario analysis for a major PSEG risk? I would define the risk precisely, identify the drivers it affects, and establish a base case before building upside and downside scenarios. For an energy company, those drivers might include demand, fuel prices, outage duration, project delays, interest rates, or regulatory timing. I would link assumptions through revenue, O&M, capital spending, earnings, and cash flow, then quantify the range. I would also identify trigger points and actions management could take under each scenario. Discuss defining the risk, selecting measurable drivers, establishing base, upside, downside cases, linking income statement, cash flow, and capital effects, assigning probabilities, and presenting decision triggers. Question 21. What financial metrics would you monitor in a utility FP&A dashboard? I would combine financial and operating metrics. Financial measures could include revenue, O&M, operating income, capital spending, operating cash flow, liquidity, debt, and forecast variance. Operating indicators might include demand, customer counts, outage frequency and duration, generation availability, project progress, and major work order trends. A useful dashboard should show actuals, budget, forecast, prior year, and key explanations. I would emphasize leading indicators so management can act before financial results fully reflect the issue. Include revenue, O&M, EBITDA or operating income, cash flow, capital spending, debt, liquidity, reliability indicators, customer metrics, forecast variance, and regulatory or operational leading indicators. Question 22. How do you distinguish a timing variance from a permanent change? I would examine the transaction detail, expected work schedule, purchase commitments, prior year patterns, and whether the variance reverses in a later period. I would also confirm the operational explanation with the budget owner. A delayed maintenance project may create a favorable current variance but not reduce annual spending, whereas a cancelled contract could lower the run rate permanently. I would reflect the distinction in commentary and update the forecast only after the evidence supports the conclusion. Talk about transaction detail, schedule evidence, historical patterns, commitments, operational confirmation, revised run rate, reversals, and updating the forecast only when evidence supports a durable change. Question 23. How would you approach cash flow forecasting at PSEG? I would build cash flow from operating performance, working capital movements, capital expenditures, taxes, interest, debt maturities, and financing activity. For PSEG, I would pay close attention to the timing of regulatory collections, customer receipts, fuel or purchased power payments, storm spending, and major capital projects. I would reconcile the forecast to Treasury and accounting data, monitor liquidity headroom, and run downside cases for demand, project delays, or unexpected operating costs. Mention operating earnings, working capital, capital expenditures, debt service, interest, taxes, financing activity, regulatory collections, liquidity assumptions, timing, and downside cash scenarios. Question 24. What accounting concepts are most important for an FP&A analyst? FP&A needs enough accounting knowledge to understand how operations become reported results. I would focus on accruals, matching, capitalization, depreciation, reserves, working capital, deferred items, and the difference between earnings and cash. In a utility environment, regulatory accounting and recovery timing are particularly important. I would never treat accounting as a black box. If a judgmental item materially affects the forecast, I would partner with controllership, document the basis, and reflect the economic timing accurately. Cover accrual accounting, matching, capitalization, depreciation, reserves, working capital, deferred items, regulatory accounting, cash versus earnings, and partnering with controllership on judgmental matters. Question 25. What questions would you ask the hiring manager at the end of a PSEG FP&A interview? I would ask how success is measured during the first 6 to 12 months and which deliverables are most important. I would also ask how the team partners with operations, regulatory, treasury, and controllership, which systems support forecasting, and what current business challenge needs the most analytical attention. Finally, I would ask how analysts develop their utility knowledge and gain exposure to capital planning, performance reviews, and senior management decision support. Ask about success measures, team structure, business partners, forecast cadence, systems, major current challenges, development opportunities, and how FP&A influences capital, reliability, and strategic decisions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.